There is a company most people cannot explain, and it just became one of the most valuable software firms on earth. The man who predicted the 2008 housing crash just called this stock a sand castle. Michael Burry is short Palantir, and he is not alone in his fear. Palantir peaked above $200. Today it trades near $132, down about 20% this year while the rest of the market climbed. Burry's math says it is worth a fraction of today's price. He calls it a sand castle propped up by the artificial intelligence story. And yet, by the numbers, this might be the single best software business on the planet. Both of those things can be true at the same time. That is the trap. So we rebuilt the methods of 5 of the greatest investors who ever lived and put Palantir on trial. 5 legends, 1 company, 1 score. But first, we do what they would do: we open the books. None of this is financial advice. It is how the great minds actually think. Palantir builds software for the hardest problems on Earth. Its first customer was the American intelligence community. Its software helps governments see the whole battlefield at once. Then it took that same engine to business. Its platform, Foundry, now runs inside banks, hospitals, and factories, turning oceans of messy data into decisions in real time. The secret weapon is what they call the ontology, a living digital twin of an entire organization, its people, its assets, its decisions. Once a company runs on it, leaving is almost unthinkable. That is the moat they claim. And the growth is staggering. Revenue up 85% in a single year. Its US business more than doubled. Here is the number that should stop you cold. Of every dollar a customer spent a year ago, they now spend $1.50. 150% net retention, the highest at this scale anywhere on the market. And the founders will never lose control. Alex Karp and Peter Thiel hold a special class of shares that locks roughly half the vote in their hands until 2032, even though they own well under 10% of the company. And demand is overwhelming. Customers are onboarded in waves, and the backlog of signed button-booked business nearly doubled in a year to almost $12 billion. And its grip on government is tightening. A $10 billion agreement folding 75 separate Army contracts into one. Its Maven targeting system made a permanent program of record. That is not a vendor, that is infrastructure. So which is it, the best business in software or the most dangerous stock in the market? Don't guess, run the numbers. Here is how an analyst actually reads a company like this. The numbers, one by one. Start with the rule of 40. Add a software company's growth rate to its profit margin. 40 is healthy, 60 is elite. Palantir scores 145, the highest a large software company has ever printed. Let that sink in. Management does not even compare itself to other software companies anymore. It compares itself to NVIDIA. That single number is the entire bull case. Number 2, gross margin. While the rest of the AI world watches its margins get eaten alive by the cost of running models, Palantir's margin went up to nearly 87%. It charges for the platform, not per question. It is immune to the tax that is crushing its peers. Number 3, this is not a company burning cash for growth. Its operating margin is 46%, right in Microsoft's league, and it throws off 57 cents of free cash for every dollar of revenue. The business is genuinely spectacular. But here is the honest catch. A chunk of those gorgeous margins comes from paying staff in stock instead of cash, about 15 cents of every revenue dollar. It is shrinking fast, but every adjusted number Wall Street quotes quietly leaves it out. And now the number that decides everything. Forget the price-to-earnings ratio. At 148 times earnings, it is not a valuation tool, it is a mood ring. The real number is price to sales, and it is 60. And it is not just high, it is in a category of its own. Microsoft trades at 9 times sales. Snowflake, the same revenue, the same scale, trades at 16. You are paying nearly 4 times the price for the very same dollar of sales. At 60 times sales, the market has already priced in 5 to 8 years of flawless, accelerating growth before the company has earned a single dollar of it. There is no room for a stumble. Strip out the cash and use enterprise value to sales, the gauge institutions trust. It is still nearly 40 times. The entire company is valued at 3 to 4 years of its most optimistic future revenue. And watch the insiders. While paying staff in stock and diluting everyone else, leadership sold over $4 billion of their own shares in a single year, a caution light flashing quietly under all that brilliance. Which is exactly why Michael Burry is short. He calls it a sand castle, trading at about 16 times its real worth, and he argues there is no true moat because Microsoft and Google could build this too. He is not betting against the business. He is betting against the price. The bulls have an answer. If Palantir simply hits its own guidance that 60 times sales compresses toward 40 next year, the bull does not need a miracle. He just needs 70% growth to keep going. The bear only needs it to slow to merely excellent. So that is the question this whole episode turns on. Can any price be too high for a truly great company? Let the legends decide. Philip Fisher, the father of growth investing. He hunted rare companies with a long runway of innovation he could hold for a decade, and he refused to sell them over a high price tag.
Fisher's model lights up. This is the kind of company he spent his life searching for. A genuine innovation platform widening its lead with customers who spend more every single year. And Fisher would do his scuttlebutt, ask the customers, the engineers, even the rivals. They would all tell him the same thing. Once you are running on Palantir, you do not leave. That is the long runway he spent his life hunting for. He famously said the time to sell a wonderful growth company is almost never. He would not blink at the multiple if the runway is real, and 150% retention says it is, but even Fisher would size it carefully here. His model scores it a 7.
A 7, the lone believer. But the next legend built his entire philosophy on the exact opposite instinct. Benjamin Graham, the father of value investing and Warren Buffett's teacher, his rule was armor: never pay more than a business is conservatively worth and always leave a margin of safety.
Graham's model is not just alarmed, it is horrified. 60 times sales, 148 times earnings, no asset backing to fall behind. This is the precise opposite of everything he taught. To Graham, a wonderful business bought at any price becomes a speculation, not an investment. There is no margin of safety here. None. He scores it a 2.
A 2 and a 7 on the same company. Then comes the man behind the trade that broke the Bank of England. Stanley Druckenmiller, decades without a single losing year. He follows the money and the momentum, bets big when he is right, and runs the instant the story breaks.
Druckenmiller's model loves the theme. Artificial intelligence, government money, a platform leader. A year ago, he would have been all over it. But he reads the tape, and the tape just rolled over. The chart is broken, down 20% while the market climbs, the very pattern he respects most. His rule is simple. Do not fight a falling winner. He would step aside and wait for it to base. He scores it a 5.
5, the momentum has left the building, but the next voice questions whether there was ever a moat at all. Charlie Munger, Warren Buffett's partner for over 4 decades, his method was subtraction: avoid stupidity, stay inside what you understand, and never overpay even for greatness.
Munger's model respects the business. High returns, real switching costs, sticky customers, but he would invert the question. Do not ask how you win, ask how you lose. And here you lose by paying 60 times sales for a company Microsoft and Google are racing to copy. A great business at an absurd price, he would say, is just a clever way to lose money slowly. It clears his quality bar and fails his price bar completely. He scores it a 3.
A 3, 4 legends in and only one is buying. One voice left, and he is the one who studies exactly this kind of moment. Howard Marks, the master of risk and cycles. His gift is second-level thinking, seeing not just the company, but what everyone already believes about it and what is priced in.
Marx's model sees a magnificent company and a dangerous moment. When a great business is universally adored and priced for perfection, the risk is not in the business. It is in the price and in the crowd. He would also warn you about the most expensive words in all of markets. This time it's different. Sometimes, rarely, it truly is, but you are almost never paid enough to bet the whole farm that it is. His central question is always the same. Where is the margin for error? At 60 times sales, with the man who called 2008 betting against it, there is almost none. He would not short it, but he would not chase it. He scores it a 4.
A 4, so the playbook closes. What does the board decide? 5 legends, 1 company. Fisher 7, Druckenmiller 5, Marks 4, Munger 3, Graham 2. The combined great score for Palantir, 4.2 out of 10. And notice what just happened. Not one of them said the business was bad, they said the price was wrong. A spectacular company scored a 4.2 entirely on its valuation. Here is where they agree: the business is genuinely elite, the moat looks real, and the price already assumes a near-flawless future. On the company, they are united. On the stock, they are scared. And here is the fault line. Fisher says a long enough runway forgives a high price. Graham says no price is ever worth abandoning a margin of safety. That argument is as old as investing itself, and Palantir is its sharpest test in a generation. A 4.2 is not the board calling Palantir a bad company. It is the board reminding you of the oldest lesson there is. A wonderful business and a wonderful investment are not the same thing. So watch one number above all others: growth. If Palantir keeps compounding near 70%, the price slowly grows into itself, and Fisher is right. If it slows to merely excellent, the multiple breaks and Graham is right. There is very little room in between. So what is your score for Palantir? Is Fisher right or is Burry? And which company should the board judge next? Tell me below. This was the Greats Playbook, where history's greatest minds judge the companies of today. None of this is financial advice. These are AI models of public investment methods, not the investors themselves. Study the greats, then think for yourself.